Introducing the balance sheet. Welcome back behind my screen. Well, what we did in the last video was we went through the income statement and we unpacked it in detail, and you saw the different elements of the income statement, and you saw how we got down to that retained earnings, which now comes across to the balance sheet. And the game plan for today is to go through the balance sheet itself and to unpack all its components so that you'll understand exactly what that is. And at the end of this, you'll be able to understand the balance sheet in a lot of detail. So the purpose of the balance sheet is just to show you a snapshot, a picture in time of where the money came from and where the money is sitting now. And that's why those two have to equal. It's called balance. And the heading in the balance sheet always says as at. It's the balance on that particular day, on that particular time. Remember with the income statement, we said it's the income statement for the period. It's for a whole period of time. This is your balance sheet on a particular day. And if you have a look over here, this is what we call the accounting equation. The accounting equation says your assets equals your owner's equity plus your liabilities. The assets is where your money is sitting now. Your owner's equity and liabilities is who you owe that money to, and those two things have to equal. And that is what we're going to unpack in detail. So here you have A equals L. Your A obviously stands for assets, and your L stands for your liabilities, and these two things have to equal. That's why they're in balance. If we split this out or unpack it a little bit further, your A stands for assets, but your liabilities are split into two. It's owner's equity and your liabilities. And this is what we call the accounting equation. If we split this out even further, your assets are made up of long-term assets. Remember, long-term assets are assets that you would normally have in the business for longer than a year. You've got short-term assets. Short-term assets are assets that would be in the business for less than a year. And that must equal your equity plus your liabilities. Now your liabilities are split into two as well. They split into your long-term liabilities and your short-term liabilities. So your long-term assets are what we call your non-current assets. Your short-term assets are what we call your current assets. Your equity is equity, and your long-term liabilities is non-current liabilities, and your short-term liabilities is your current liabilities. So these are the headings that appear in your balance sheet. So if you look at your balance sheet, you will see these headings, and I will show you that momentarily. So here we have it. Here's your balance sheet, or your statement of financial position. And if we take your non-current assets, where are they? There they are. And it's sitting in your balance sheet, and there's some detail around it. Your current assets are there. Can you see? Both of these are on the one side of the balance sheet with the heading assets. The other side of the balance sheet says equity and liabilities. And your total assets come to 7206. The other side of the balance sheet, you have your equity and liabilities. And then you have your non-current liabilities. And then you have your current liabilities. And if we add all of these up, it comes up to the same number. And you can see both sides are equal. And so the one side of your balance sheet tells you your assets, where your money is sitting at the moment. The money in this business is sitting in property and plant and machinery and equipment and vehicles and some other financial assets. And it's also sitting in short-term assets. Short-term assets are assets that we would have in the business for less than a year. In other words, it rolls over. For instance, inventory or stock. We have stock, we sell it, we get more stock, and hopefully we're selling it within the year. You've got trade and other receivables. This is what we used to call debtors. This is money that is coming in. These are people who owe us money, so it's our asset. You've got cash and cash equivalents. Cash is money that is sitting in cash or close to cash. And on the other side, you've got your share capital. That's the money you originally got when you sold shares. There you've got your retained earnings. Those are the profits from all the previous years. And then you might have a couple of other components of equity, and that makes up your total equity. And your non-current liabilities are long-term borrowing, long-term debt. When we say long-term, more than a year, any debt that we have longer than a year. You might have an item like deferred tax. That's just a timing issue between you and the tax man. And sometimes it's an asset, sometimes it's a liability, depending on whether you owe the tax man or he owes you. And then you've got your current liabilities, and your current liabilities are trade and other payables. That's what we used to call creditors. That's where you now owe somebody else some money. You might have some short-term borrowings, a short-term loan. You've got the current portion of a long-term borrowing. So you might have had a long-term borrowing, but now you owe a portion of that back this year, and that's your current portion. And that's how the balance sheet is split up, but it all relates back to what we can see at the top there, which is our accounting equation. If I take my non-current assets, what are they made up of? They're made up of buildings, equipment, furniture, computers, cars, patent and goodwill. Now, can you see that the patent and goodwill are in a different color? And you know why that is? Because there's a difference between these and these. Your buildings, equipment, furniture, these are what we call tangible assets. You can touch and feel them. Your patent and goodwill is what we call intangible assets. They are still assets, but you can't touch and feel it. So if you have a company that sells medicine, let's call it Adcock Ingram, and they get a patent to manufacture some drugs, the patent can be for 10 years. That is an asset, but you can't touch and feel the asset. You've got a contract that says it, so those become intangible assets. Goodwill is something that confuses people, so I'll give you a very quick explanation. The only time you have goodwill in your books is if you've bought another company and you paid more for that company than what the assets were worth. In other words, if I buy another company and I pay 2 million rand, and the assets are worth only 1 million rand, I would record those assets as assets in my book. And because the balance sheet has to balance, I say, well, what do I do with that extra bit? Why did you pay more for this company than the assets? And that's the goodwill. So a lot of people think goodwill is that you put your own goodwill in your own books. You don't. It's only there if you've bought another company. And then your current assets would be things like cash, stock, money in the bank, accounts receivable, or prepaids. A prepaid is when I've paid something in advance. In other words, I've got a car, I pay insurance on it. Let's say I paid 1,000 rand a month on my car. And I phone up the insurance company and I say, listen, can I pay you everything up front? And if I do, if I pay you for the whole year up front, can I get a discount? And they say, sure. If you pay for 11 months up front, you get 1 month off. So you're covered for 12 months, although you've only paid for 11. Now, if I'm in the middle of the year and I write up my books, half of the money that I paid on the insurance on my car is for what has happened. The other half is still going to happen. I've paid in advance. So at this point in time, that money still belongs to me. That is a current asset. It's my money sitting in someone else's account. Okay, it's the same as accounts receivable. Accounts receivable, people owe you money. It's your money that's sitting in someone else's account. So are prepaids. Your equity is made up of the money that you got originally when you sold shares and the profits that you've accumulated through the years in the business. Your non-current liabilities are any long-term loans or mortgage. Remember, any long-term greater than 12 months. And then your current liabilities could be a short-term loan, could be bank overdraft, could be accounts payable where you owe people, and it could be unearned revenue. Unearned revenue is the opposite of the prepaids. Unearned revenue is if I, in that example, was the insurance company and I'm drawing up my accounts, I've got money in my accounts that I haven't earned yet. And so at this point in time, it's treated as a liability, but it's a short-term liability. Now, a lot of people get confused with depreciation. So let's have a look at depreciation. So here's a simple income statement, and I'm going to use this to explain this whole concept of depreciation. So you've got sales of 800. Less cost of sales of 500 gives you a gross profit of 300. You've got a whole lot of expenses that come to 250. And if you do this, you get the operating profit of 50. And now I go and I buy a car. And let's say the cars costs 135. So cars are expensive. So I put it under expenses. And if I did that, it would show me a loss for this year of 85. Now what I've done there is wrong. But the question is, why is that wrong? I've spent money on a car. It's expensive. I've put it under expenses. What's wrong with that? And the key concept here is that I'm buying the car today, but I'm buying it for a use over a period that is longer than just this year. So I'm paying for it today, but I'm using the car over the next 5 years. So theoretically, I need to split that cost of the car over the next 5 years. Now it costs 135. I'm saying, well, let's say I'm going to be able to get, I estimate, 35 back for it after 5 years. Now I've got to split the rest of that 100,000 over 5 years. So if I take 100,000 divide by 5, I get 20. And so I will put 20 then in here, but for the next 5 years. And every year I'm putting the 20 in. We're splitting over the 5 years because the taxman gives us a guideline that cars should be depreciated over 5 years. Furniture would be 10 years, for instance. This 20 that I've got over here, where does that come from? So when I buy the car, I record it in my balance sheet at 135. But then I take, every year, I take the 20 out of the balance sheet and I put it as the expense. The next year I take the next 20 out of the balance sheet and the next 20. Can you see this is accumulating? 20 plus 20 plus 20. So this we call accumulated depreciation. But in your books, when you have a look at it, you get the asset is at NBV, net book value. And the value in your books would be the 135 minus the 20. Then minus the 40. And then minus the 60. So you can see in your books that the value of the asset looks like it's going down in value. It's not really reflecting going down in value. What it's reflecting is the allocation from the balance sheet into the income statement. And I think a better name for this, instead of calling it depreciation, is allocation. And in fact, the next time you hear the term depreciation, in your mind, swap that word to allocation. All depreciation is the allocation of the cost over its useful life. And in this particular case, we've got this. We don't call it car, we call it depreciation. And here you've got your income statement, and why it's important is it shows you your operating profit for this year is 30. It's not the 50 it was, but it's not the minus 85 that we had previously. This is what depreciation is, and we're allocating the cost over its useful life. Now there's a term called amortization. Now amortization is exactly the same thing as depreciation. The only thing is that amortization is for intangible goods. So we depreciate tangible goods, we amortize intangible goods. When we apply depreciation, we have many methods of applying the depreciation. So the most common one is the straight line method. This is the same method as what was used in the example I gave, where you take a fixed amount per year. In this case, we're depreciating over 4 years, so you take 25% per year of the amount that you're allocating from the balance sheet into the income statement. We call that depreciation. You could use a different method. You could use something called the reducing balance method. In this method, you would take, for instance, 25%, but in the first year it would be the same 25% of the original amount, but from then onwards it would be 25% of the remaining balance. So the second year would be 25% of 75, then 25% of 56, etc. There are many other methods that one could use. There's something called the sum of the digits. There is other depreciation which is on actual usage. So for aeroplane engines, there's a fixed number of hours that can last, and so you depreciate it over that period on actual usage. If we look at it graphically, then the straight line method would look like this. It's a fixed amount over each period, and it's exactly the same amount. If we looked at the reducing balance method, it would look like this. More in the beginning and less as we go along, but for a longer period, almost like flattening the curve. So you could choose which method you want to depreciate by, but it should actually reflect the way you use the asset. And all you are doing is you're allocating the cost over its useful life by taking it out of the balance sheet and putting it as an expense in the income statement. Because when you buy something, that's what it is, and it is an expense. Because as I said earlier, you can't just put it into the income statement as an expense, because then you're not treating it correctly, because then you're treating it as an expense only this year, where you're not matching it over its useful life. And that goes with what we call the matching principle. You have to match the income and expenses to the period in which it's being used. I just want to highlight something for you, because we have two different perspectives. So according to accounting and IFRS, the balance sheet looks like this. Often we take the balance sheet and we manipulate it a bit into a different format that gives us a business perspective, which allows us to do some of the calculations slightly differently. So let me show you this. According to IFRS, we've got one side of the balance sheet, non-current assets plus your current assets, and that's your total assets. And on the other side, you've got equity, non-current liabilities plus current liabilities, and that gives you your equity and liabilities. What we could do is, if we could take this current liabilities from the one side of the balance sheet and we could move it to the other side of the balance sheet. And if we move a plus from the one side of an equation sign to the other side of the equation sign, it becomes a minus, and there you have your minus current liabilities. And therefore your one side of the balance sheet would look like this: non-current assets plus current assets minus your current liabilities, and that would equal your equity and your non-current liabilities, what we've got left on the right hand side. Mathematically, these two things are exactly the same. They will balance, but on a different number. And this we look at and we say that your non-current assets plus your current assets minus your current liabilities, we call that net assets. Remember, the top one's total, this is net. In accounting, the term net is used when we net something off. When you minus something from something else, it becomes a net. And that's why this is net assets. It's highlighting that we have a minus in this equation. And the other side just becomes your total capital. Now, this is the business perspective. And often we want to have a look at what's your returns divided by your net assets. So this gives you your net assets. So we're just rejigging in the balance sheet so we can have a look at it. By the way, the accounting perspectives is the way the balance sheet looks according to IFRS. Before IFRS, we used to create accounts according to something called GAAP, General Accepted Accounting Practice. And the business perspective one is the way the balance sheet would be laid out if we were reporting according to GAAP. Your current assets minus your current liabilities has two names. It's either called net current assets, remember net meaning we're netting something off, or is also called working capital. Not sure why it's called working capital. It makes you think the other capital's not working, but that's the term. Current assets minus current liabilities is either net current assets or it's called working capital. So really what we're doing is we're taking a balance sheet that looks like this, and we're making it look like this. The balance sheet looks a bit smaller, and it's just because we're moving a plus from the one side to a minus on the other side. Remember the different terminologies between the accounting perspective and the business perspective. It's equities and liabilities and total assets, and now it would be called total capital and net assets, but it is the same balance sheet. And now that you have this information, I would like you to go and do the exercises that you have. And we've got a number of exercises that I would like you to download, and you can do those exercises. And then when we meet next time, we'll unpack those exercises. I look forward to seeing you behind my screen.